Welcome to This Week in Money. I'm Jim Goddard. Today, dollar vigilante Jeff Berwick on what our true inflation rate is and who's to blame. Tim Cyclesman Wood warns equity markets are dangerously overbloated. And financial advisor Richard Knowles on whether those markets will continue to rise or will explode. We talk to Jeff Berwick right after this.
More and more people are looking to the internet for intelligent, riveting, and thought-provoking interviews. To advertise on The Goddard Report and TalkDigitalNetwork.com, call 604-699-8600, 604-699-8600. Welcome to This Week in Money, the source for market opinions. Sitting in for Phil Mackesy, here is Jim Goddard.
My guest is the dollar vigilante, Jeff Berwick. Rumblings on the precious metals market, a warning sign. The richest people in the world just met in London about sharing their wealth, but will they? And new statistics show once they have revised all the numbers, the U.S. saw a 1% reduction in its economy in the first quarter. Well, first of all, Jeff, let's talk about the rumblings you talk about in your newsletter.
Yeah, there's a lot of stuff going on, and a lot of people aren't really hearing about it. Of course, the mainstream media doesn't really cover a lot of these sort of important things. And there's a lot going on. Of course, I talk a lot about the coming end of the monetary system as we know it, and I see a lot of these things as being a sign of a coming collapse of the monetary system. And I'm not saying it's going to happen tomorrow, but these are all very symptomatic. There's been a lot of things happening all in the last month. The London silver fix was ended. This is a silver fix price, so it's a group of people, which is a ridiculous system when you think about it, that actually sets the price of silver in London. And this has been going on since the 19th century, and they have just announced that they will stop doing that on August 14th. So that's very interesting, something that some people should find interesting at the very least. And what it really means, it's hard to say, but it is interesting. There's been all kinds of gold manipulation lawsuits coming out. There's been numerous lawsuits. There was a lawsuit brought up by many people, including the Alaska Electrical Pension Fund, a number of private citizens, hedge funds, and they were suing a number of banks for rigging the gold price. There's also been Barclays was just fined recently $43.8 million last week for failures of internal controls, which allowed the traders to manipulate the settings of gold prices. So that's interesting. There's all kinds of things happening. Austria, just this month, announced that it wants to audit its gold in London. This has been going on for quite a while now. Of course, Germany said that they wanted their gold returned from the U.S. A few months ago, and the U.S. Government said to them that they'll return it over, I believe, they'll return it in about 7 years. And they said that they'll return a very small amount of it now. So this is very interesting because, of course, that is legally or really the government of Germany's gold. And the U.S. government is saying, well, we'll send it to you eventually. So this brings up a lot of questions, a lot of things that I've talked a lot about, including things like, is there really any gold in Fort Knox? It's been over 60 years since it's been audited. And as I've said before, if it's been 60 years since you've seen something, and especially when it's the government who says that they have it, it's probably not there. And just the fact that this is never brought up is very interesting. So there's a lot going on. And of course, China continues to accumulate precious metals. They're the largest importer now by far. A lot of the precious metals are all moving to Asia. And that's very symptomatic of this collapse. The Western nations, including the U.S. and Europe, have all been going very socialist and part fascist, part communist over the last 10 or 20 years. And so they've been going down in terms of their economies over the last few decades, whereas a place like China, which used to be very communist, is now actually more capitalist in many ways than the U.S., and so you're seeing a lot of the wealth moving over there. So there's massive movements afoot that most people don't even hear about behind the scenes. And, well, it's not even behind the scenes. This is all publicly announced, but you really don't hear it on your nightly news because they don't want you to know about that. They just want you to know that some kid who had a problem meeting girls killed some people in Santa Barbara and things of that nature, or Kanye West, or somebody's getting married to some some person. I don't even follow it. I don't know, but that's what's on the news in many people's households on their television programming, and they call it programming for a reason. So I would say it's that they pay attention to what's going on and find this information. Of course, you can find it at our website, thedollarvigilante.com, just dollarvigilante.com, and be aware, because the government and the media are not going to tell you what's going on, and there's an actual collapse going on, and this is happening all in real time, and it will just get worse and worse from here.
Jeff, you say there are massive moves afoot that most people aren't aware of. And I watch the evening news. They always have what the Dow has done for the day, the S&P, the dollar, the price of oil. But I think unless they tell you why those numbers are what they are, those numbers mean nothing.
Yeah, a lot of this is all a bit of a game at this point. You're seeing the U.S. stock market at record highs right now, but it's all in nominal dollars. It's all not really in real dollars. So for example, the Dow is at record highs. It's over 16,000 right now. It was around 10,000 a few years ago, and a lot of people say, well, the stock market's gone up so much, but it really hasn't. It's been a lot of money printing, and a lot of that money has just been going into the stock market. And so it fools a lot of people. And so because of this money system that we have today, which is all based on nothing, it's not backed by anything, and because of all the governments and the central banks are printing so much money, it's really almost impossible to tell the real value of anything in the markets anymore. And it really confuses people. So what we're seeing in the U.S. right now is unheard of, with the stock markets at record highs and the Federal Reserve with interest rates essentially at 0%, or close to it. And with printing unheard of amounts of money for the Federal Reserve, it's now been over 5 years of over 10% per year in actual monetary inflation, and in the printing and the increase of the money supply. But at the same time, you have a lot of economic problems. You're seeing, and it's all the symptoms are showing, things like people like who work at McDonald's saying that they can't afford to live on the minimum wage anymore, and things like that. But that's because of the money printing. And so this always happens the same way almost all the time, is that they print money. A lot of it goes back into things like stock market and bonds, and it goes out into the economy. But by the time it reaches your average person, all the prices in the economy have already gone up, and they usually gone up more than the price of their wages. And so this is what's causing all these problems. Yet if you look at Janet Yellen or the Federal Reserve, they will tell you that they still need to print money. And the reason they say that is because if they stop printing money, the U.S. government is so indebted now that the entire U.S. government would collapse, because they'd be insolvent if they stopped keeping interest rates manipulated at near 0% and did not print money to increase the money supply to pay for these deficits, which are still nearly $1 trillion per year in the U.S.
And it doesn't help that we have conflicts that are changing the value of currencies as we speak.
Yeah, there's, as always, the U.S. government and many of these governments are causing problems all over the world. Of course, the latest has been in the Ukraine. There's just constantly causing problems. I don't know why anyone really wants these governments for anything. They're a completely unnecessary evil. Central banks provide nothing to the economy. They actually destroy economies. And governments do nothing except for screw up economies and cause problems and wars and things of that sort, which are completely unnecessary. So yeah, it's a wild time to be alive, but I think it's all coming, it's going to come to an end quite soon, thankfully. And a lot of people would say, well, it's not good that the U.S. dollar is going to collapse and the entire world monetary system is going to collapse. Well, it's definitely going to be a very difficult transition for a lot of people, but it is good that this system collapses, because people really don't understand how impoverished they've actually been by this system. You look back in the U.S. 40 years ago, the average person had more income or more ability to live a better lifestyle than people of today, and it's just because the increase in taxes, increase of debt, things like that have just made it harder and harder for people to get ahead. If you look back, of course, to things like the 50s or the 60s, it was usually just one man working in a household. Usually, this is just usually or on average, the woman would usually be the mother who would stay at home. And now it's almost impossible for your average person to have just one person in the family, one parent, getting income, and it usually needs to be both. And then, of course, they put their kids into schools all day, public schools, which are mostly indoctrination camps, which don't really teach them how to create wealth. It just teaches them how to work in slave labor jobs for the most part. And of course, it just gets worse and worse from there. All this is caused by the government and the central bank.
More with the dollar vigilante, Jeff Berwick, next on This Week in Money.
Always consult your investment professional before making any investment decision. More and more people are looking to the internet for intelligent, riveting, and thought-provoking interviews. To advertise on the Goddard Report and TalkDigitalNetwork.com, call 604-699-8600, 604-699-8600. This Week in Money is archived online at TalkDigitalNetwork.com.
Welcome back. We're speaking with the dollar vigilante, Jeff Berwick. The U.S. economy contracted 1% in the first quarter, with revised numbers just being released. They were telling us it was going up. Which numbers do we believe?
Well, never believe anything the government tells you, first of all. To say first, GDP is not a good number to track growth of an economy. That shows the amount of expenditures in an economy. And of course, anyone who knows anything about economics knows that you don't get rich by spending more money. That's really what GDP tracks. If, for example, the U.S. government were to go into a world war where it was massive expenditures and massive deficits and massive amounts of money borrowed, that would actually increase the GDP dramatically because of the expenditures. So that is not growth at all. Secondly, they really warp these figures massively. They don't really include real monetary inflation in the GDP numbers. As I just mentioned earlier, the actual amount of monetary inflation over the last 5 years has averaged over 10% per year. That's what inflation is. The rise in prices is just a symptom of the increase in the amount of dollars in the world. And so they don't really what the U.S. government uses is another statistic that is completely adjusted and manipulated. They use CPI to show what the price of the increase in the price of goods. But that number is so warped and manipulated, it's truly unbelievable. They really do things like if steak starts to get more expensive, they'll replace it in the CPI index with things like hamburger. And if hamburgers get too expensive, they'll replace it with bologna. And it just goes on and on like that. And that's how they do it. And that's how they try to tell people that there is an increase in prices. But your average person fills up at their car at a gas station or sends their kids to university or anything of that nature knows that prices are increasing dramatically. So if you were to actually adjust the GDP for the true monetary inflation, the U.S. economy would have actually shrunk 11% annualized, given these first quarter numbers. So there's nothing, all these numbers are totally false. They're hollowing out the economy through all of the things they're doing, through all the debt and taxation and regulation. And then at the same time, they're printing money, which is just destroying the economy at the same time. But it also has the added side negative benefit of fooling people into thinking that the economy is okay because they see there's quite a bit more money around. Things seem to be going on, but it's mostly people spending more money than they have because they think that the economy is doing okay, whereas they should really be battening down and getting ready for what's going to be the greatest depression.
Conflicts in Syria, Libya, Iraq. A lot of people have told me those are because those countries were making noises or had actually made moves to move away from the U.S. dollar as their reserve currency for the trade of, say, oil.
Yes, this is something that not a lot of people seem to realize, but almost every war that the U.S. has instigated, and you have to remember that the U.S. has essentially been at war almost since its founding. I believe there's been 15 or 20 years total out of the over 200 years where they haven't actually been attacking a country. And after 9/11, of course, General Wesley Clark is very well known for having said that just days after 9/11, he was given a briefing from the Pentagon, I call it the Pentagram, that said that they're going to attack 7 countries over the next 10 years. And on that list were Iraq, Afghanistan, Syria, Libya, Iran was the last one, and a few others. And they've actually gone on to attack most of those countries now. So this has all been planned out. At the same time, the ones that they've really gone after have been the ones that have tried to get away from the U.S. dollar. So Saddam Hussein, before he was hunted down and hung by the U.S. government, he had said that he wanted to start selling oil for euros instead of dollars, and very quickly that country was attacked. Literally millions of people had their lives destroyed over it. And same with Libya with Muammar Gaddafi. He was trying to start up a African gold-backed currency, and a few weeks later, they were air bombed by the U.S. and including the Canadian military also participated in that. And he was attacked brutally in the streets by a lot of these people that the U.S. government had sent in there and killed. And so this goes on and on. Even Dominique Strauss-Kahn, who you might remember a few years ago or a year or two ago, he was starting to say that the International Monetary Fund should start moving away from the U.S. dollar. And then a few weeks later, he supposedly was caught raping a maid in a hotel in New York and was removed as IMF chairman. And a few months later, those charges were dropped because there was no evidence of it.
Jeff, 250 of the world's richest people met in London this past week about inclusive capitalism. But they didn't sign anything about how to share those 250 people own 1/3 of the world's assets. Now, talk about an imbalance in a balance sheet. Will these people get it, or will we see revolutions again like Russia or the Chinese revolution where anybody with money is going to be a target?
That seems to be the way it's going, and that's certainly what the mainstream media is trying to pump out, is very anti-capitalism sort of ideas. And what they're saying, and what a lot of people are talking about, is that these people are meeting at the Bilderberg group meeting in Denmark right now. Many of them got most of their wealth through theft, through taxation. People like the royalty, they stole most of their wealth. A lot of these large corporations all got a lot of their wealth through monopolies given to them by the state and state protection and state subsidies. And so, yeah, there's a lot of people who are angry about it, but a lot of what they are angry about, I think they've got wrong. They think that capitalism is the problem, but true capitalism doesn't have things like central banks or taxation or regulation. All of these things that have caused a lot of these wealth inequalities, and because of that, people just get it misconstrued that the reason why these people have so much wealth and so many people are so poor is because of capitalism, but that's not the case. It's actually because of government and central banks, mostly central banks. Central banks are a completely heinous contraption. They're actually a part of one of the main tenets of communism. If you want to have a communist society, you need a central bank to print money for the government. It has nothing to do with capitalism, and it's all of these systems that create this incredible wealth inequities and allow these people to continue to take money from other people and don't give. It's not done in a voluntary transaction. It's actually taken through theft, through taxation and subsidies and things of that sort. So yes, those people are meeting in Denmark right now, and it's amazing how people are starting to catch on to these things, because these sort of meetings, including the Council for Foreign Relations, Bilderberg, and Trilateral Commission, many of these, they used to be just talked about as being conspiracy theories, but because of online journalists and independent media today, they're being outed, and it's becoming quite well known that these things exist now, and that many of the financial elite and power elite that control many of the governments around the world and central banks do meet yearly and do come up with plans to keep their system in place.
I remember watching a documentary about Bernie Madoff, who made off with billions of other people's money. And it was said during that documentary, the Rothschilds, the central banks, and all these nations, the richest people, knew he was ripping off his clients, but they were heavy investors with him, and they were making so much money from it, they never blew the whistle.
Yeah, it was very interesting to see that, because it was really a Ponzi scheme, and it's funny because things like the Social Security in the U.S., that's also a Ponzi scheme, but that's fine. So it all depends on who you are stealing from and who's involved if the government's going to come after you. It is interesting to note, though, that Bernie Madoff is one of the only people in this recent financial crisis collapse that's been going on for the last few years. One of the only people. There's been no bankers who have literally stolen trillions of dollars from the economy of the U.S. And had given to them by the Federal Reserve. None of those bankers have gone to jail or anything. The only person who's gone to jail is Bernie Madoff, and that's because a lot of his clients actually were people like those financial elites. And so that's why he's gone to jail, is because they did lose money in that eventually at some point. And so it's just funny to see how these things all work.
Would sending any of these major bankers to jail make any difference? Some people have told me they view it as, okay, the head of this mafia family has been knocked off. Well, somebody else just moves in and it's business as usual anyway.
Yeah, the problem is systemic. It's not to do with any one individual or any one company. It's an actual problem with the system where you allow, these banks are all contraptions of the state. None of these banks like JP Morgan or Goldman Sachs could exist in their current form in a free market. It just wouldn't be possible. They wouldn't have all of these abilities that they have now to just create money out of thin air, which is how the banking system in all of the Western world and most of the world works today, is these banks can just create money out of thin air. And so they couldn't grow to this size. They couldn't have this much aggregation of power in a free market. So to put a few people in a cage is not going to solve anything. Other people will just move in and the game will continue. That the real thing, and this is something that Ron Paul, of course, talked a lot about, is first of all, end the Federal Reserve, end all central banking. That is the real root cause of most of our economic problems in the world today. It is a completely thieving and heinous system that actually destroys economies. There's absolutely no gain or value to humanity of having central banks. It only really allows the wealth transfer from quite poor people to incredibly rich people. And so that should be the real focus, and not just trying to find one or two people and put them behind in a cage. That's not going to solve anything.
Do the governments have the will, the strength, the ability to make the changes to make that happen?
Well, the government would never do that because that's what funds the government at this point. So we have to get rid of government as well. That's the only real answer to all these problems that we have in the world today. And if people aren't quite ready to get rid of all governments, then what I would say is, let's just have more governments. Having bigger and bigger governments is a problem. So let's have more governments, but have them be smaller and smaller. For example, in the U.S., it started out as a number of states were all essentially sovereign states that had united under the United States of America, but they were all essentially sovereign. That power was actually taken away by the fascist Abraham Lincoln, who took over federal power of all those states. So he grew a larger government. But the smaller the governments are, and the more of them that there are, the better things are for everybody. As you probably know, and I'm sure you know, municipal governments don't cause too much problems. They cause a lot of problems, but it's nothing too big. Then you get to the state or provincial level, they cause more problems. And then it's really the nation itself, the large government itself, that causes a lot of problems. So the more that you can have smaller governments and more governments, the better. So if we could actually see the U.S. go back to 50 sovereign countries, that would be a massive improvement. And then if we could eventually get it down to every city becomes its own sovereign government, that'd be another improvement. And then if we could ever get it to 7 billion sovereign independent governments on Earth, we would have peace and prosperity like we've never known it.
Jeff, is there a website people can go to find out more about what you think and what you believe?
Yeah, thank you very much. It's just the Dollar Vigilante is our blog. You just go to dollarvigilante.com. We have a little email box right in the top right corner. If you just put in your email there, we send a daily blog talking about all these issues.
After the break, Tim Cyclesman Wood on This Week in Money.
More and more people are looking to the internet for intelligent, riveting, and thought-provoking interviews. To advertise on the Goddard Report and TalkDigitalNetwork.com, call 604-699-8600, 604-699-8600.
This Week in Money is archived online at TalkDigitalNetwork.com.
My guest is Tim Cyclesman Wood, editor of Cycles News and Views, which you can find online at cyclesman.com. Welcome to the show, Tim.
Thanks for having me, Jim.
People are wondering, your so-called 4-year cycle, well, we're years beyond it now. What is happening?
It's extending. We are dealing with the longest 4-year cycle advance in stock market history. No question. That doesn't change anything. It's just an extension, and history shows that the longer something extends, the worse the revision to the mean. As an example, The previously, well, we have two cycles that we can look back at. I mean, until this one, we're in month 62 now. But the advance into 87 was the first 60-month advance, and we know how that one ended. I think it ended with a 41% decline. And then we saw the advance into the 2007 top, which was coincidentally 60 months on the dot, and we saw how that ended. It ended with the worst financial decline since the Great Depression. And so there is a clear indication that the longer a cycle extends, and those are two extreme examples of that, the worse the revision to the mean. And the thing that makes this so dangerous is that not only do we have the longest now 4-year cycle advance, but then it's the foundation or the lack of solid foundation in which the rally has been manufactured. Let me ask you a common sense question, Jim. If I told you that, and I could present hard evidence, and I told you that the labor participation rate, or the market force, or whatever you want to talk, however you want to say it, was at levels not seen since 1977, 1978. What would you say about that? I mean, what's your initial response just on that statement?
Well, I was thinking back in the late 70s, we had full employment. We had very high inflation, but also high employment.
Well,
do we have high employment now?
No. And the point is that back then, I'm looking at the chart right now, the labor force, or the labor participation rate was around 60, let me get the number, 63%. Right now, we're sitting at 63%. And it peaked with employment, the percent, and this is a percentage, this is the labor force percentage. It peaked in 99 at 67% roughly, little 67.5, something like that. And so my question is, when you look at this data and you see that the rate of employment, or if you will, the number of people as a percentage of the employable people, is back at levels, it's declined and is back at the levels not seen since 77, 78, how is it that we're in a recovering economy? That's my point. And when you look at another measure, when you look at the velocity of money, let me ask you this, and the velocity of money is, how fast does a dollar turn over? I spend $1 with you, and then you go spend the $1 with the restaurant, and then he goes and spends the $1 with somebody else. That's the velocity of money, how fast the money turns over. And when you look at that data, it peaked in 1997 with the stock market, or just before the stock, it peaked, I say that, let me clarify. It peaked just prior to the 1998 4-year cycle top in the stock market. The market went down into a 4-year cycle low later in 98. It made one final push back up into the 2000 top with the next 4-year cycle top, very left translated, and then down into the 2002 low. So what I'm saying is that the velocity of money peaked just ahead of that 1998 4-year cycle top, and then it diverged with the 2000 top, did not confirm the 2000 top, and then has literally just collapsed since. So if people aren't employed, and if the dollar is not turning over, changing hands, I fail to see how that is. I mean, to me, that's the very essence of a solid economic foundation.
So what is this market based on?
Liquidity, smoke and mirrors. And that's the point. That's what I'm saying. That's why I feel like that this is the most dangerous setup. If you look at this data going back into, I mean, I'm looking at the job participation stuff all throughout the secular bull market that we were really in the 40s and the 50s and the 60s and the 70s and the 80s and up into 2000. It's going up. More and more people are working. You look at the velocity of money chart, it's going up. The dollar is turning over, it's spending, people are spending. You look at the volume of transactions, just the NYSE volume. In that secular bull market period of the 70s and the 80s and the 90s, volume is going up. And on the market declines, the volume is going down. That is a signature of a bull market, of a secular bull market. This job participation data, the velocity of money data, all of those things are the very essence of a sound economy and a secular bull market. But now, since the 2000 top, it's all been, and I don't know if I can say this, but it's all been BS. It's manufactured. It's not real. And I'm not denying the fact that price is where the price is. Yes, price is where price is, no doubt about it. The Dow Jones Industrial Average is at a new high. But it's not real. There's no basis. And that is what makes it so dangerous. Just like, this started with the last 4-year cycle advance. I say it started with the last 4-year cycle advance. Let me clarify. It started with the 2000 top. That's where the economy and the stock market and everything peaked. Every measure, economic data that I look at tells me that the natural top was in 2000. The efforts to keep the market afloat began then by the money masters. And if you just ask yourself the common sense question, if the economy was sound, I mean, did they do QE in 1970 or 1980 or 1990 or 1998? No, it didn't have to, because the economy was expanding, as these charts show us, with expanding volume in the stock market, with the labor force participation rate going up, with the velocity of money increasing. And now we have the opposite, and they've stepped in and done this. And what I'm saying is that it's, from that perspective, it's not real, it's not sustainable, and it's not going to last, and it's not going to end well. And another just common sense thing for people to think about is that they started these things in 2000. The market made the 4-year cycle low in 2002, and then we had the second longest extension of a 4-year cycle into the 2007 top on this very same foundation that we have today. And I said back then in 2005 and 6 and 7, just as I've been saying now, and I know the message got old and it got stale and it was, people were going, yeah, same old thing. But I warned emphatically, I said, there's no way. All these efforts are making matters worse. And that's how it ended. It was the worst financial decline, disaster, whatever you want to call it, since the Great Depression. And since the 2009 low, job participation rate has continued to decline. The velocity of money has continued to decline. The volume, shares traded in the stock market, it's a train wreck looking at that data. It's continued to decline. It ticks up on the down when the market is down, and it just continues to dwindle as the market goes up. It's just a levitation act. And so what we have is more of the same in an increasingly worse environment, and it's just an absolute recipe for disaster now.
What should an investor do? What should an investor do, Tim?
Cash. Be on the side. I mean, what is wrong? Everybody is so greedy. They're so greedy. They want that return. This thing, I will say, I don't think, like I said, the DNA markers are not, it's not completely set up. What I fear is that it just implodes on its own weight before it sets up. But if you go by the statistics, going back to 1896, I've identified all this stuff. It should give us a nod. It should tell us. I should be able to identify it for my people, when the setup is in place. But what if, there's that fear, what if I can't? What if it just is, because it's so extended and because of this baseless, when I say baseless, I realize it's all based on liquidity, but I mean true fundamentals and technical basis, or fundamental technical and economic basis. That's void. That's not there. And so when I say baseless, that's what I'm saying. And so my fear is it just implodes. I don't think that's going to happen. I think we're going to see the setup surely because of the statistics. And my point is, though, is that people are so greedy, they think they have to be in the market. They want to be in the market. They want to be in the market. They want to get every little nickel out of the market. And I'm telling you, this is the most dangerous environment. When I sit back and look at these charts going back to 1896, and you look at the volume, and you look at the behavior of the charts, and you look at the statistical norms, and you look at this underlying, this is an absolute powder keg. And yet it keeps pushing.
Tim, is there a website or a newsletter people could subscribe to take a look at some of the charts you have and why you have this feeling that the equity markets are nothing but a powder keg right now?
I don't call my newsletter a newsletter because I think it's beyond a newsletter. It's a research letter. I give people hard data. If any analyst, if any politician, if anybody that gets on TV or on some talk radio show or writes some article and posts it on the internet or in some magazine, if they say that this is a secular bull market and that this is a recovering economy, either A, they don't understand what they're saying, or if they do understand, then they are a liar, they are being manipulative, and they have an agenda to try to keep the market going. And like I said, I cannot overemphasize how dangerous this setup is or this environment is. And once it's set up, I don't think there's any stopping it.
And where should people look on the internet?
Cyclesman.com. Some of the technical stuff takes people a little longer to get their heads around, but it's worth the effort.
After the break, Richard Knowles on This Week in Money.
More and more people are looking to the internet for intelligent, riveting, and thought-provoking interviews. To advertise on the Goddard Report and TalkDigitalNetwork.com, call 604-699-8600, 604-699-8600.
This Week in Money is archived online at TalkDigitalNetwork.com.
My guest is Richard Knowles of Knowles & Associates in Vancouver. He's a personal and corporate financial planner. He's also a recipient of the 2013 5-Star Wealth Manager Award. Welcome to the show, Richard.
Oh, thanks, Jim.
Well, we're at the end of the month, and we're going to ask, have we seen the typical sell in May and go away in the equity markets? Or are they going to continue booming along at record high rates? We're already at an extended 4-year cycle, its longest ever. Well, Richard may be on the side about why it won't continue. Maybe tell us about that.
Well, I suppose one of the best things we want to realize is the statistical probability issues. If you're a mathematician and you've studied the markets long enough, you know we go through cycles, and these cycles are extremely regular. It's unusual, but it's almost like a biological cycle in many ways. There are many things that can throw this off, as any biological cycle can be thrown off as well, for that matter. We have, on average, it's a 6 to 7 year cycle. We have a growth phase, which lasts on average between 6 to 7 years, and then we have a recessionary period, sort of an alleviation of the pressure of growth, so that we can recharge and restart. Now, what's interesting about these cycles is they can be triggered by many different reasons. But if you look at a standard cycle, you can go back decades and see these cycles occurring, certainly North America-wide. And there's also a global cycle, but it's less regular because there's too many factors in the globe, emerging markets versus China versus, or Asia versus, Europe, etc. But the North American cycle has settled in to somewhat regular cycle. But even with this regularity of 6 to 7 years, we see variations on this theme, and they're usually triggered by, and I like to use the analogy of a running race where, you have somebody running full out for a period of time around a track, and they just simply have exhausted themselves. They have to stop. It's not that they can't run again. It's just that they have to slow down. They could even go to a jog for a while and just drink lots of water and keep the body moving. Then they can do another, really hard run again. And in a sense, that's what a recession, in effect, does. It gives a break to the economy because it just can't continue on unendingly spending. It's just a natural evolution of our economic condition. Jobs slow down. It doesn't have to go into a deep recession as we've had in the past, but there's usually a triggering effect. In 2008, that triggering effect was the bank and mortgage crisis. There was just too much craziness going on in that, and that blew up. In 2000 and 2001, in 2000 it was the tech bubble burst. Again, something that was just going gangbusters and making North America go crazy and having fantastic growth, eventually blew up and kind of had to restart again. It's certainly not over. We've seen some great moves in technology since then, Google, everything else, but it's become more of a regular growth system. It's become part of our system, the economic system and financial system. So there's lots of reasons to see that there's going to be a correction. And if you look at it statistically, and with fundamental reasons. There are some basic fundamental reasons that have yet to be seen, but statistically and technically, we expect a correction. So when we're seeing the end of this cycle, we are in the phase of the end. It's not necessarily this month. Often we look at sell in May and go away. 9 out of 10 years, that actually occurs to a significant degree, a significant enough degree, 10% or more correction. You sold in May and then came back in October and November and bought again and then ran those cycles each year. No matter what, you'd be further ahead, depending on what stock it's, of course, and what, types of investments. But if you took an average growth stock and you did that every year, and it was growing as a normal stock, and you just want to pick, say, a bank stock or something else, perhaps not a bank stock, something more of a growth stock, good automobile stock or something like this, which has grown over time, one of these types of ideas. And if you did that consistently, you would be further ahead than if you had just held it throughout the whole time. Now that's an old statistic. It's been around a long time. But of course, that's not taking into consideration taxes that you might have to pay if you sell your investment at a profit. The taxes you might have to pay for, that is for capital gains or for income that you might generate on dividends. This is just a straight numbers analysis. So while it's nice to know numbers work that way and can work for you, and that there's a probability we might see a correction, what's the value in buying something that has a good solid income that may not correct that much and that you can use? So ultimately it's the use of your money. If you're using it to live on it, if you need income from it, you're say have an income fund which is paying you a solid 5% a year and paid monthly, and you're getting a good stable income from that. It's in a seg fund, so your principal is guaranteed. You've got all the things going for you. You don't sell in May and go away. This is a trading trick. It's a trading secret, if you like. It's out there. It's a way to add some value to your portfolio if you don't have any tax consequences. For example, it could be in an RSP or a TFSA. As a broad range trick, or as a broad range thing to do, I don't recommend it. It's a select type of vehicle to do. A lot of traders do it because they're just profit taking at a high risk time, and and remember, we're at the end of a 6 or 7 year cycle. If you've been in the cycle the whole time, you've been making a good amount of money. And so do you take your profits off the table now, or are you starting to sell off? When do you do that? Because of these old expressions, sell and may go away, people have been moving some money off the table in May. Simply because this is when they plan to do it.
Richard, why are some people saying equity markets are going to continue to go higher, and they're not predicting an end to this good boom time at all?
Why is the other half of the room put their hands up, when they think it's going to continue to go up? Well, there are a lot of fundamental things happening today that are showing good signs. Some of the negative signs, before we leave that, would be China's slowdown in their iron ore. We've seen a disparate change between the iron ore. You can almost chart Canadian stock markets based on iron ore production in China. That's an interesting statistic. But for the last 6 months and longer, we've seen the first time we've seen a divergence in that number. In other words, the stock markets have continued to go up in Canada, even though Chinese iron ore digging or production has dropped significantly in China. It's the first time we've seen this opposition going in different opposite directions. So what does that tell us? Well, that maybe if the Canadian markets are continuing to go up, that if it does recorrect back to the Chinese iron ore figure, that we will see a correction downwards to catch up with that. So there's always these various things that we're watching to see what's kind of scaring us to think it's going to go down. However, should the right things occur, in other words, China's starting to recharge again, India's elections, there's some fundamental things happening there, so there's lots of business developments going to open up in India with Canada. There's lots of reasons to believe that we have a very good summer ahead of us as well. But they're not on the table. These are speculative things that have yet to occur. So the people that are trading in stocks thinking, should I stay, should I go, are more or less now, we're noticing a shift. They're shifting from the riskier stocks that could suffer in a drop or a decline into the safer harbor stocks that pay dividends, the more bigger blue chips. These are the ones that are holding on. So that's really the answer to the question is we don't really know, but I think by securitizing your money, by looking at what the purpose of your money, what it's used for, and repositioning into different types of investments, this will strengthen your decision. And if you make your decisions based on just the best trade of the day, I think people struggle and they go crazy with those kinds of things. Look at what your money needs to do for you and then make the appropriate decision. Stick with your decision with a good advisor.
Richard, is there a website or email that people could contact to find out more about what your thoughts are on the subject?
Certainly. Contact my business email at Richard K, that's the letter K, Richard K, at customplanfinancial.com.
Thanks to our guests, Jeff Berwick, Tim Wood, and Richard Knowles. And thank you for listening. I'm Jim Goddard for Phil Mackesy. We're back next week with more This Week in Money.
This Week in Money is a production of Howe Street Media Incorporated.